Hi, Trent Bradshaw with Bradshaw Financial Planning and Mind Your Money. Thank you for joining us for this webinar, Year-End Tax Preparation. We've got a special guest with us today, Brent Park, CPA. Brent, I appreciate you being with us. Also got Brandon Rogers, Certified Financial Planner, with us, and we're going to have just an open discussion about maybe some strategies we could utilize going into the end of the year to help improve, of course, what the IRS has given us to save on some taxes in some ways. Brent, let's jump into the first slide and kind of go high level. Let's talk about the tax brackets. What's changed there?
Trent, there's not been a lot that's changed over the last year or so. These are tax brackets that were passed several years ago through some legislation. And what's important to remember on this is that these are favorable brackets, but they do sunset in several years, which means that it's important for us to continue to take action each year to try to take advantage of these brackets, but they're not going to be around permanently.
Right. And that's, Brandon, you had mentioned something on that to try to take advantage of where we're at right now, utilizing the tax brackets and strategies, especially that 12% tax bracket for a lot of folks.
Yeah, I mean, just taking a look at the 12 bracket, I mean, we'll have some examples, I think, later on that talks about, potential Roth conversions, or just look at his taxes historically and just see, hey, are these actually lower rates when you look at it on over a long period of time? But again, we'll kind of look at that, focus in. But everybody's situation is different, of course, but it could be something everybody could utilize for sure.
And one thing we'll notice, Brand, as far as the income levels, they did slide up a little bit, maybe about 1 to 2% on each tax bracket. Is that just standard with CPI every year? Do you see the brackets widen a little bit?
Yes, that's consistent. Historically, that's very consistent in that these brackets, the standard deductions, several things within the Internal Revenue Code are interest rate and inflation sensitive. And so as those increase over time, we do get a little favorable standard deduction, and also the rates will expand some just through natural inflation.
Okay.
That really kind of leads us into the next slide. As Brent was talking about the standard deductions, it really has that broken down as far as married, filing jointly, and single rates, of course. But, with the standard deductions here, Brent, we get a lot of people asking us about, obviously, withholdings there, as well as, hey, if I'm giving money, do I itemize, or is my standard deduction big enough? Can you talk a little bit about that?
Yeah, in practice, we've seen that not as many people itemize any longer because of the doubling effect of the standard deduction. And I just leave it up to each client each year. We have a pretty good track record with a lot of ours as to what their historical deductions have been. But I also advise new clients that it's not a bad idea just to try to itemize. The state standard deduction is lower than the federal, so you may pick up a few extra dollars of a state refund by doing that. And so for the most part, these standard deductions are robust, and they will probably eliminate a lot of people from itemizing at this point in time.
Right. So home interest, mortgage interest, home equity line of credit interest, a lot of that has been eliminated. A lot of people can't take advantage of that anymore.
Only it's all there, and it's all still deductible. It's just a matter of where the cumulative total exceeds the standard deduction. And one of the bigger hits that we've seen is what's called the SALT deduction, the state and local income tax. Mm-hmm. Now that that's been capped at $10,000, that takes a lot of people that you would think otherwise could itemize out of the equation because of how low of a cap that is on your real estate taxes, your state income taxes, and the likes.
Okay. Well, on the next slide, we're talking about tax deduction strategies. There's a few things that we can touch on there. What are some of those strategies, Brent, that we can utilize to reduce our taxes?
Well, there's a lot of standard things, a lot of things we've had historically that have not changed. That you don't have to itemize your deductions, perhaps to take it, and that would be college education, student loan interest. If you do a tax favor deduction at your employer plan, then that takes the income off of your tax return. IRA contributions are still available. There's really not a whole lot that's available other than your itemized deductions, but there are some health savings arrangements also allow you a deduction if you do not itemize. We'll also get into qualified charitable distributions. And so there are a handful of tax favorable strategies that we can look further into.
Okay.
And obviously, if you're a business owner, there's just a lot more there that's available inside of the business before that income ever reaches your personal tax return. There's a lot more availability for deductions at that level.
Right.
Okay. Yeah, kind of moving into that next slide is kind of what Trent mentioned before is some tax strategies along the way. I mean, one thing that, some people can really utilize is a Roth IRA conversion. So, Roths, a lot of people still are kind of in the dark about them, and the most part, have been around for a long time, but we're seeing more and more adoption of the Roth. And, basically it's, paying tax on your monies now. We've got some comparisons of historical tax brackets there, and some things bullet pointed here of what are some advantages of the Roth. So there's some definitely some great advantages there. And Brent, what are you seeing there? I know we've got an example here as far as Roth conversion. Are you seeing more people try to take advantage of this?
I think some of the more sophisticated tax filers are, especially the ones that work with advisors like yourself, are taking advantage of this opportunity. Basically, what we're trying to do is convert some of our income that's contained inside of a taxable account. We're trying to determine the most appropriate time to free that income up and pay the income tax on it. And while we have that historically low 12% tax bracket, we're encouraging it. I know that you guys are, and we are seeing people that are each year able to convert part of their income to 12%. After they pay that tax burden, that income has the potential to be tax-free after that.
Well, that's a good point. You mentioned sunset in regards to the tax brackets that we've got now. I think it's January 1, 2026, but obviously we have an election this year. Mm-hmm. If that were to change, there's a good chance that potentially would change immediately and not be out there until 2026. So taking advantage of it in 2020 is even more critical. Would you agree?
Yes, basically anything that you see in the tax law is there until it's changed. And so these rates will automatically change in the future, but Congress can change pretty much anything that it's done. It can undo at any point in time. A lot of times we see that happening after a presidential election. So it is important to go ahead and take advantage of these opportunities as they present themselves.
One of the things that we I hear a lot is, what if it changes, right? I mean, obviously you got that legislative risk that always happen. I mean, what typically happens if the IRS does come in or legislation comes across the table that does change this tax code? What usually happens? Is it just kind of retroactive to everybody? Is it they draw a line in the sand? What do you usually see there? Because I know that's a big fear for a lot of people.
For the most part, most tax legislation takes place prospectively, so that there's only been maybe one time in history where there's been a retroactive change. So, and generally it doesn't take place in the year of election just because it takes time for someone to establish their tax protocol. But it could really happen within a short period of time. At some point in time, you have to think that rates are going to go back up to help pay for a lot of this assistance that we're handing out right now through all this, economic relief. At some point in time, funds are going to have to be collected to start paying back some of this debt that we're accumulating. And so we're just not promised that this is open-ended, so we should take action immediately.
I mean, we should pretty much expect taxes to be going up in the future, like you said, with the increasing debt that the country's taking on, especially going through these uncertain events like we've gone through. I mean, it's almost a definite that it's going to happen. The question is just when.
Perhaps sooner than later, Trent, but
right.
That's the reason why we're trying to educate folks to go ahead and take action.
Right. Well, another strategy that we've looked at, if you look on the next slide, we're talking about tax harvesting. Brandon and I talk about this a lot. We're talking about capital gains, capital losses. Kind of explain how folks need to take a look at that and take advantage of it and what the pros and cons are there.
Well, I know you guys are very proactive in reevaluating your portfolios on an ongoing basis, and it tends to happen. It's on cyclical basis that you may have a stock that may be down some going into the end of the year, and perhaps you've already generated some capital gains throughout the year. So basically what you're trying to do, and the IRS will allow it, is to sell a position and go ahead and realize that loss. And so perhaps that would offset some type of gain that you generated either in the market, or you could have sold any other type of highly appreciated asset throughout the year, land or anything like that. And so it's important going into the end of the year to take a look at what's happened. And then is there some opportunities perhaps to recognize a loss by liquidating position? Even if you like that position, you can still sell it. The main thing you have to be aware of on this is the wash loss rule that says you can't buy back in that position for 30 days or that loss basically washes out. So that's the only other feature you should keep in mind.
Right, right. And every now and then you'll see that occur, and you can correct it. You just have to go back through and wait that 31-day period like you just described to recognize that loss if you were to do it. Yeah, yeah.
Okay. Kind of moving on to the next slide is a really, nice strategy that, again, another thing that's kind of a secret out there in a way, but, we try to educate as much as we can like we're doing today to look at qualified charitable distributions. I mean, look at, again, we talked earlier where the standard deduction is, and if people are itemizing, I mean, this is actually a good way to look at taking or giving monies to a charity directly through your IRA. It's very you got to follow a process, and you got to be strict about it. We've got some things laid out here, but what are some things that, Brent, that you kind of look at for the kind of QCD, or again, the qualified charitable distributions? Are you seeing that kind of step up some more now too, especially where we're at tax rates?
Yeah, this is a very tax-friendly provision that the IRS put into the tax code. And your qualified charitable distribution basically means that you can forego the deduction by just having the funds sent directly out of your IRA to the charity. And the good news about that is it doesn't have to be included in your income. And so it works very well when you start getting into retirees that have paid off their house perhaps and don't have enough to itemize their deductions. So they're still charitable minded. They don't need the charitable deduction. Perhaps they're required to take the money out of their account, and so they will just send the money directly to their charity, and it doesn't have to come into their income, so it doesn't increase their income. They don't need the deduction because of this new robust standard deduction. And so it's a very good strategy that we're getting more and more people comfortable with, because a lot of people get set in their ways and they just like to be regular givers through their checking account. But once we sort of educate them, they will respond to the tax savings and basically make these distributions right out of their IRA to their charity and save on having to report that as income.
Well, I know this has been very beneficial, not only from my church, but we've talked to some other charitable organizations that they're starting to see some traction in this area where people are recognizing required minimum distributions and how they can defer those over, or just simply gifting after age 70 and a half to these charities directly from the IRA. So yeah, it's definitely catching some steam coming out of the gates here. Yep. Hey, next slide, I want to jump over and just talk about, Brandon and I are asked about this all the time, Brent. I just wanted to touch on it. People have concerns in regards to giving assets away to maybe family members, friends, children, grandchildren, whatever it happens to be, because they think they're going to be taxed on those particular gifts. Talk a little bit about the gift tax.
Yeah, Trent, that question is raised a lot, and a lot of people think that gifting intertwines into the income tax side of the tax code, but gifting really doesn't appear as an income tax function. The person that gives the gift away doesn't get a deduction for it. The person that receives the gift is not receiving a taxable gift in general. So it's really a transfer of wealth where you're just deciding to transfer funds from one person to the other. However, the IRS does have a whole body of laws regarding gifting. And they basically say that you can gift your annual exclusion each year without having to report any type of transaction. I'm pretty sure that's $15,000 for this year. So you can gift any one person $15,000. If you go over that, however, there's a backstop of what's called a lifetime exclusion. And each one of us, including the three of us on this panel, have over $10 million of lifetime exclusion. So we can really gift not only limited to the 15, but an unlimited amount, perhaps almost up to our lifetime exclusion without creating any type of tax obligation.
Right, and I think, Brandon, that level is set at 11.58 million right now. So it's pretty much, for the most part, most of the population unlimited at this point.
Yeah, we get that. Again, we get that question a ton. So, it's always good to have some guidance on that. So,
And just before we switch panels, it is a reporting requirement that if you gift more than $15,000 a year, so it does not, generally it will not become a taxable event, but there is a compliance reporting requirement. So it's important for people to keep that in mind, whether they're giving away cash or transferring real estate or whatever. It becomes a reportable item.
It's still not a taxable event. It's just a reportable item so they can use some of that lifetime exclusion like you were talking about.
Exactly.
Okay.
And then just kind of looking at the next slide, obviously we had a change this year as far as your deadlines and tax reporting and everything. But it's really important, obviously, to take a look at all this throughout the year. If we want to look at Roth conversions, look at it, at the end and end of the year potentially, so you know what your income's like. And that's more tax planning instead of tax preparing. So what are some deadlines when you really need to look at, Brent, as far as tax breaks, filing your tax returns, things of that nature?
I think that probably the biggest takeaway is for people to realize that this extension this year on the individual side was just based on circumstances, that our normal due dates are going to revert back unless something different happens. And so, we're here at the middle of the year, and it's really important to do those planning items, probably qualified charitable distributions. You want to think about that during the year before you give all your money away that you're going to. If you start thinking about doing that in November, perhaps you've already done all your donations, so you're not inclined to do any more. So, on the qualified charitable distributions, it's something you should think about throughout the year. A lot of times on the Roth conversions, we talk about perhaps waiting until the second half or the third or fourth quarter of the year, because you never know if there's an income windfall, if you inherit an IRA account or something like that could put you into the next bracket. Then those are fine waiting until the back end of the calendar year to do those planning. But and then most people probably realize that with your health savings contributions and your IRAs, those can be made after your calendar year before the April 15th due date. But for the most part, we'll probably get back into our normal due date trends. But here again, it's important to work with myself and work with your team to continue to monitor these things, those capital loss harvest, those loss harvestings or those netting. Those are just things that just need to be monitored, and clients need to participate in that process at some point in time during the year.
Well, I know as a business owner, being able to sit down in that November, December timeframe and making sure that we've covered everything, every opportunity that's given to us by the IRS is critical. And then working with you as a CPA has been highly beneficial. So, Brandon and I really push that and talk to the clients and also business owners in regards to getting that tax plan done, because it is that important. So next slide, you'll see how can we help. Brent, basically, I know from your end, it's the tax planning part of it. People have got to be willing to come in, sit down with you as a CPA or their CPA, whoever it happens to be, and go through this planning and not just come in for preparation. So ultimately, getting this planning done is where you get the highest benefit from it. So definitely recommend that everybody listening to the webinar take advantage of working with your CPA and coming in and doing that planning prior to year end. And also realize that these CPAs are busy too. So, that October, November, December timeframe, they're going to start getting these appointments for these reviews and everything to start doing this planning. So go ahead and set your time so you can get this done. It may only take one time and that's all you can do, but that's okay. At least you took the effort in getting it done as far as sitting down with that specialist and let them analyze where you are currently.
Well, that kind of wraps it up. If anybody has any questions about anything, obviously reach out to us, reach out to Brent. We always want to be here to help and answer questions, give you some guidance. But like I said, just always have that plan together and have a good team on your side, and everything should work out great. But I want to thank everybody for joining us, and again, want to thank the special guest there, Brent Parks, for taking some time and going through all this. But This is Brandon Rogers and Trent Bradshaw with Bradshaw Financial Planning and Mind Your Money. And make sure you follow us on social media and YouTube videos. We'll release more and more of these videos throughout the year. So again, let us know if we can help in any way. Thanks for joining us.